Hello and welcome to today's daily educational video here at Forex.Academy. I am, of course, your host, Robert Blackwell, and have the pleasure to walk you through today's daily education. Before we do so, of course, let's consult our disclaimer. There is risk involved trading the financial markets, so do be aware of the risks involved. And without any further ado, we will discuss today's webinar content. We will be debating contracts for difference, really the preferred method to trade leverage, to trade a retail product here in terms of providing the leverage so that we can trade the price of oil, so that we can trade Forex markets, equity indices, and really it gives us the opportunity to really have a great wealth of trading opportunity across a wide range of asset classes. So let us ask ourselves the most important question, of course, what is a financial derivative? Well, a derivative is simply a product which derives its value from an underlying asset. The derivative itself is a contract between two or more parties agreeing to buy or sell at a specific price, which is based upon or replicates the value of the underlying asset itself. The ability to trade derivatives on asset prices allows us to simply speculate on the movement of price without physically owning the asset itself. So you could imagine if you want to trade the price of oil, it would be quite difficult to actually physically own 1 barrel of oil if you wanted to speculate on that price movement. Instead, we can trade something called a CFD, or a contract for difference, to simply agree a contract between another buyer or seller in the marketplace to simply speculate on the movement of price. In understanding our role in the retail trading environment, we can focus our attention then on the various retail trading products available to us as retail traders. Many of these products carry very different features. Okay, so we have financial derivatives such as spread betting accounts, we have option or binary options accounts, we have CFD accounts. They all, of course, carry very different features. Some have very great advantages to the trader, while many have serious pitfalls. So it is important to understand what we choose to trade and why. And this is one of the reasons why we choose and prefer to trade the contract for difference, because it allows traders to enter into a contract simply between buyers and sellers to speculate on the price. So there's actually an agreement there within the liquidity of the market. Although the market is synthetic, it follows and underlies the price of that asset, in comparison to something like a spread betting account, where of course that is an agreement with yourself, the trader, against the broker, just like you're placing a bet with a third party there. The broker holds that risk on account, and it's not necessarily trading with the liquidity of the market. CFDs are typically the preferred leveraged instrument to retail traders. Now, if we think, why is that the case? Well, we are able to trade a large amount of notional size when we're trading CFDs. If you prefer to trade perhaps a Forex market, we can start a very relatively small account size with 200 or 300 euro and actually access 2 to 3 or potentially 20 or 30,000 euros worth of capital to trade in the Forex markets. CFDs are available on a variety of asset classes, enabling more active opportunity and portfolio diversification. So you can trade Forex pairs, you can trade commodity markets, you can trade equity indices, you can even trade cryptocurrencies. There are a whole array of CFD products that allow you to effectively diversify your portfolio across these markets. CFDs are quite cheap to trade, particularly in Forex, and I'll use one example there. To trade a 0.01 lot or a micro lot on the euro US dollar, that commonly will cost you around 3 or 4 pips per trade. So with that trade size, you will effectively be charged 3 to 4 cents on the trade. So very cheap to actually enter the markets. And CFDs allow both long positioning and short selling. So of course, as an investor or trader, you're very much concerned with taking long positions in the market. Well, what does that mean? It simply means that you're looking to buy the market and hope to sell it at a higher price. So if the market in question you purchase increases or appreciates in price, then you'll look to sell it back into the market for profit, of course. But we know as traders that does not always happen. The markets are quite volatile. We often see the markets move to the downside. The contract for difference itself allows us to speculate on price movement, whether it moves to the upside or downside. So effectively what we can take is short positions. So again, as previously mentioned, because we don't physically own the asset that we're trading, so let's say we're trading the price of gold, we don't physically own a bar of gold or a portion of that bar of gold. We simply speculate on the price, meaning we can take a sell or a short position, and if the price moves to the downside, we can exit it for a gain of an appreciative gain as the market trades to the downside. So effectively, we're able to trade both sides of the market, and that allows us to speculate on much more a profit opportunity. So that concludes our a quick daily educational video for today. Thank you very much for joining us here at Forex Academy. See you next time. Bye for now.